What if I told you that most investors could have skipped hours of research, avoided sleepless nights, and still beaten the majority of stock pickers? Hi, I am Warren, and today, I am going to walk you through the real story of the legendary three-fund portfolio, how it works, how it stacks up against hand-picked stocks, and what the numbers look like after a decade of tracking both. This is not a theory. This is not a sales pitch. This is what really happens when you put passive indexing up against active stock picking, year after year, through bull markets, bear markets, pandemics, and everything in between. Let's start with the basics. What exactly is a three-fund portfolio? Imagine you want to invest, but you do not want to spend your life glued to CNBC or reading financial statements. The three-fund portfolio is the ultimate set-it-and-forget-it strategy. It is built around three simple ingredients. First, the total United States stock market index. Think of this as owning a tiny slice of every major American company. Apple, Walmart, Microsoft, you name it. With one fund, you get exposure to thousands of businesses, from tech giants to local utilities. Second, the total international stock market index. This covers Europe, Asia, emerging markets, literally thousands of companies you have never heard of, but should own. Why? Because sometimes the best growth happens outside the United States. Third, the United States Bond Index. Bonds add stability, reduce volatility, and give you dry powder for crashes. When stocks zig, bonds often zag. They are the ballast that keeps your portfolio steady in rough waters. You can build this with three exchange-traded funds: VTI for United States stocks, VXUS for international, and BND for bonds. A typical allocation is 50% United States stocks, 30% international, and 20% bonds. That is it. No guesswork, no news watching, no hot stock tips. Just broad global diversification at rock-bottom cost. Let me pause here and explain why this works. Index funds are like owning a piece of the entire economy. If one company fails, it barely makes a dent. If a sector booms, you benefit. And because these funds are self-cleansing, the losers drop out and the winners rise to the top automatically. It is the investing equivalent of autopilot. Now let's contrast that with stock picking. For the past decade, I have picked my own stocks. But I do not do it randomly. I follow strict rules. I only buy companies with at least 10 years of profit growth. I look for wide moats, brands, patents, network effects. I demand a strong balance sheet, which means low debt and high cash. I favor shareholder-friendly management, companies that pay dividends or buy back shares. And I never chase hype. I buy at a discount to fair value. My process is intense. I screen over 1,000 stocks down to 20. Then I do deep dive research, earnings calls, 10Ks, competitive analysis. I then built a concentrated portfolio, 15 to 20 stocks, never more than 10% in any one name. Sounds smart, right? But how did it actually do? Let's look at the numbers. Over the last 10 years, the three-fund portfolio using a 50-30-20 split returned an annualized 8.7%. Its worst year was minus 16%. Its best year was plus 25%. The Sharpe ratio, which measures risk-adjusted return, was 0.68. My stock picks? Annualized return, 10.1%. Worst year, minus 27%. Best year, plus 32%. Sharpe ratio, 0.54. So yes, my picks edged out the index on returns. But look at the volatility. Bigger swings up and down, more gut-wrenching drawdowns, and lower risk-adjusted returns. The index was smoother. The three-fund portfolio lost less in bad years and recovered faster. That is the power of diversification. Let's break down why that matters. Imagine you are on a roller coaster. Higher returns are great, but if the ride is so wild you want to jump off at the worst possible time, you end up losing. That is what happens to a lot of stock pickers. They panic and sell at the bottom. With the 3-fund portfolio, the ride is much smoother. You are less likely to make a costly mistake. But there is another cost people do not talk about: time. The 3-fund portfolio takes maybe 1 hour to set up. You buy your 3 funds, set your allocation, and you are done. Once a year, you rebalance. Maybe another hour. That is it. Now let's talk about stock picking. I spent over 300 hours a year on research, earnings calls, reading filings, and monitoring the news. That is more time than most people spend at the gym. And it is not just the hours. It is the mental load, constant alerts, decision fatigue, second guessing. You are always wondering, did I pick the right stock? Should I sell? Should I buy more? The emotional side is real. Passive investors, those who stick with the 3-fund portfolio, sleep at night. No fear of missing out, no panic selling, no, what if I missed the next Tesla? They trust the system and let compounding do its thing. Stock pickers, constantly second-guessing, fear of missing out, tempted to sell at the worst times. I have felt it. The urge to sell during COVID. The regret of missing Nvidia's run. The pain of watching a sure thing drop 40%. The 3-fund crowd? They just keep buying. They do not sweat the headlines. Let's get practical. Who should pick stocks, and who should stick to the index? If you love research, can handle big swings, and have time, try picking a small portion, maybe 10 to 20% of your portfolio. If you want simplicity, sleep, and solid returns, stick to the 3 funds. Most people should go passive and use their time to make more money elsewhere. The truth? The 3-fund portfolio is undefeated for most investors. Stock picking can work, but it is a second job. Your time, your stress, your goals. That is what matters. Let's dig a little deeper. Why do most stock pickers underperform? It is not because they are dumb. It is because the odds are stacked against you. For every Apple or Nvidia, there are dozens of companies that go nowhere or even disappear. Index funds guarantee you own the winners because they are always in the basket. When you pick stocks, you risk missing out on the next big thing, or worse, betting big on a loser. Let me tell you about a few times I got it wrong. Years ago, I bought into a hot tech stock everyone was raving about. It soared for a while, then crashed 60% in a matter of months. Meanwhile, the S&P 500 just kept chugging along. I learned the hard way. Chasing hype is a losing game. On the flip side, there were times I nailed it, bought a little-known healthcare company before it got acquired, or invested in a boring utility that quietly doubled over 5 years. But for every win, there were 2 or 3 misses. That is the reality of stock picking. The 3-fund portfolio, on the other hand, is all about minimizing mistakes. You are not betting on any one company, sector, or country. You are betting on the global economy. And history shows, over the long run, that is a bet that pays off. Let's talk about fees. Index funds are dirt cheap, often less than 0.05% a year. Stock picking, especially if you use mutual funds or advisors, can cost 1% or more. That may not sound like much, but over 30 years, that difference can eat up a third of your gains. And then there are taxes. Index funds are tax efficient. They do not trade much, so you do not rack up capital gains taxes every year. Stock pickers, more trades, more taxes, more headaches. Now let's address a common question. But what if I want to beat the market? Here's the honest answer. It's possible, but it's hard, and most people do not. Even the pros underperform the market after fees. If you want to try, do it with a small slice of your money. Treat it like a hobby. not your retirement plan. Let's look at some real-world data. According to research from Bogleheads and other sources, the average return of the three-fund portfolio is proportional to the percentage of stocks you hold. The more stocks, the higher the average return, but also the bigger the drawdowns. The sweet spot for most people is between 40 and 70% stocks. That gives you growth without too much pain in bad years. For retirees, the three-fund portfolio's safe withdrawal rate, the amount you can take out each year without running out of money, is best between 50 and 80% stocks. More than that, and the risk of big losses goes up. Less than that, and your money may not grow fast enough. Let's talk about the psychological side. The biggest risk in investing is not the market. It is you. The urge to panic sell, to chase winners, to abandon your plan at the worst time. The three-fund portfolio is designed to protect you from yourself. It is simple, boring, and effective. Let me share a story. During the 2020 market crash, I watched my stock picks drop 30% in a matter of weeks. It was gut-wrenching. But my three-fund portfolio? It dropped too, but not as much. And because I was not worried about any one stock blowing up, I was able to stay the course. By the end of the year, both portfolios had recovered, but the three funds gave me a lot less stress along the way. Here's another angle: time. What's your time worth? If you spend 300 hours a year on stock research and you could make more money working, building a business, or just enjoying life, is it really worth it for an extra 1% return? If you even get it. For most people, the answer is no. Let's wrap up with some actionable advice. If you are new to investing, start with the three-fund portfolio. It is simple, cheap, and effective. If you get the itch to pick stocks, do it with a small slice. Consider it your fun money. Track your results and be honest about your wins and losses. If you are an experienced investor and love the process, keep at it, but do not fool yourself. Measure your performance, factor in your time, and remember that simplicity often wins. Your challenge: try the three funds for a year. Track your time and your stress. Then decide if you want to go deeper. Now, let's compare the numbers for the last decade up to May 2025. The Bogleheads three-fund portfolio, using 80% stocks and 20% bonds, returned about 8% per year compounded, with a standard deviation of 12.4%. The deepest drawdown was minus 43%, which took 42 months to recover. The S&P 500 returned about 10% per year over the same period, but with greater volatility and a heavier concentration in United States tech stocks. The three-fund portfolio was less risky and more globally diversified, but lagged slightly in total return compared to the S&P 500, especially in the last bull market for United States tech. If you want the absolute highest return, you could have just bought the S&P 500, but that means betting everything on the United States and living with bigger swings. The three-fund portfolio gave you a smoother ride, more diversification, and less risk of missing out on global growth. In the end, the three-fund portfolio is not magic. It is just the simplest, most effective way to capture the power of the markets without losing sleep or spending your life on research. It is the best choice for most people most of the time. For those who want to go deeper, stock picking can be rewarding, but it comes with a cost: your time, your energy, and your nerves. Thanks for listening. Next time, I'll tell you how buying designer clothes prevents you from retiring. Until then, remember, simplicity wins. Happy investing.